In the landscape of global economics, the disparity in gross domestic product between Europe and the United States stands as a testament to the diverging paths of economic development and policy priorities on either side of the Atlantic. In 2008, the Eurozone and the US boasted comparable gross domestic products at current prices, standing at $14.2 trillion and $14.8 trillion respectively. Fast forward 16 years later, and the Eurozone's GDP has edged slightly above $19.3 trillion, while the US GDP has surged to $27.9 trillion, a whopping $8.6 trillion larger than the European Union's. Consequently, according to the European Center for International Politic Economy, situated in Brussels, the GDP disparity has reached 80%. A released report comparing GDP per capita across American states and European nations shows worrying trends. In this ranking, Italy barely surpasses Mississippi, which is the least affluent of the 50 states, with France positioned between Idaho and Arkansas, ranked 48th and 49th respectively. Germany also finds itself in an unfavorable position, nestled between Oklahoma and Maine, which are ranked 38th and 39th. This trend of economic influence appears poised to persist, showcasing Europe's resilience and determination amidst challenges, while the United States economy demonstrates robust health. Europe's economic stagnation isn't a new phenomenon, rather it's part of a long-standing trend. Historically, Europe has been a formidable economic force, but the tables began to turn in the early 90s. The United States started gaining ground, and Europe began to lag behind. Today, the echoes of this shift reverberate in the economic challenges Europe faces. For instance, Germany, once the continent's economic powerhouse, is now teetering on the edge of recession. Inflation rates are persistently high across the continent, further compounding the issue. Some critics argue that comparing GDP figures can be misleading due to the volatility of exchange rates. Exchange rates do fluctuate, and this can skew the perception of economic performance. But even when we take this into consideration, the broader picture remains the same. Europe's economy is stagnating. So, what's at the core of the persistent divergence between the US and Europe's economies? Europe's economic region isn't a monolith. It's a diverse landscape with advanced economies leading in competitiveness, innovation, and productivity, along with those still playing catch-up. A trend emerges over the past 2 decades: rapid growth in Central and Eastern European countries that joined the EU, contrasted by sluggish rates in continental economies. The Euro area, comparable to the US, has been particularly disappointing. Trailing behind the US since the 80s, it's contributed to a decline in the EU's overall economic performance. This lag has structural explanations, but let's delve deeper. Overregulation. Europe finds itself predominantly hampered by its own regulations. Excessive red tape and overregulation stifle productivity growth, while fragmented capital markets impede efficient funding, a myriad of rules that hinder innovation and complicate business operations within the Eurozone, compared to the US. According to the World Bank's Doing Business rankings, EU economies excel in only 2 indicators: obtaining electricity and facilitating cross-border trade, and even then, the lead is marginal. Lack of European tech giants. The US is home to tech behemoths like Apple, Google, and Amazon, which not only dominate their respective markets, but also drive global technological innovation and consumer behavior. These companies have vast economic influence, enabling significant investments in research and development. Europe, by contrast, has fewer companies of this scale in the technology sector. This discrepancy is often attributed to factors such as market fragmentation, regulatory environments, and differing approaches to innovation and venture capital. Limited private capital availability. The US benefits from a more dynamic venture capital scene, making it easier for startups and tech companies to secure funding. This ecosystem supports rapid growth and innovation. Acquiring credit is notably challenging in the EU, particularly inhibiting startups, and companies must navigate through diverse national laws and tax regulations. Meanwhile, EU initiatives aimed at economic development are usually complicated, resulting in delays such as with the allocation of next-generation EU funds and failing to incentivize increased private sector capital expenditure as seen in the US. Furthermore, political considerations and national interests have thwarted progress in establishing a capital markets union, which would enhance cross-border risk management, reduce reliance on bank financing, and enhance capital allocation to foster greater economic growth. University rankings. American institutions consistently dominate global university rankings. credited to their heavy investment in research, flexibility in curriculum, and ability to attract top talents globally. European universities, while historically prestigious and still highly regarded, often rank lower in global comparisons. This can impact the continent's ability to produce cutting-edge research and innovation, particularly in fast-evolving fields like technology and science. So, as we can see, the persistent economic disparity between the US and the EU isn't just about numbers. It's a complex interplay of various factors. However, it's not all doom and gloom for Europe. Despite these challenges, the narrative that the EU has significantly fallen behind the US in economic terms requires further exploration. Europe has chosen a different path, a path that places value on the quality of life over pure economic output. In terms of inclusivity, Europe sets the pace across various aspects, encompassing equality, social advancement, and overall life contentment. Income disparity stands at a mere 29.6, notably lower than the United States index of 41. This is also reflected in the continent's commitment to a better work-life balance, with shorter work weeks and longer vacations. When analyzing economic output through lenses such as per-worker output and output per hours worked, the EU shows signs of convergence rather than divergence. European workers are becoming more efficient, even if the total economic size remains smaller than the US's. When we reflect on productivity and the balance between work and life, the EU often outperforms the US. The average employee works around 40 hours per week in the US, in comparison to Europe average of 37.5. This indicates that European workers are efficient and possibly benefit from better work-life balance, social policies, and labor protections. Another win for Europe is its leadership in the green transition. Eurozone economies exhibit significantly lower total and per capita CO2 emissions than the US. Additionally, the EU is at the forefront of green goods trade, with Germany alone surpassing the US in green exports, 19 out of the 27 EU economies showing a comparative advantage in this domain. In contrast, the US is gradually losing market share, and its comparative advantage in green technologies is deteriorating over time. As the EU aims to accelerate its green transformation and achieve net zero emissions by 2050, the green economy is poised to generate more jobs, compensating for potential deindustrialization in declining sectors. And then there's healthcare. European healthcare systems stand as a testament to the continent's values, offering near universal coverage. This approach often results in healthier populations and, in many cases, superior health outcomes compared to other regions. Europe boasts the highest life expectancy globally, averaging at 80.5 years, outstripping the United States at 79.3 years. But let's be clear here, these decisions and the resulting lifestyle advantages are only part of the story. They do not negate the economic challenges Europe faces. Yet, it's crucial to recognize that these lifestyle advantages, while enriching, do not exist in isolation. They are intricately intertwined with a broader economic framework. A high quality of life is not sustainable without a robust, flourishing economy to underpin it. In essence, these decisions and their associated benefits mark just a segment of the larger narrative. They underscore the interconnectedness of economic stability and quality of life. As we conclude our video, it's imperative to acknowledge the ongoing economic endeavors and the pursuit of a thriving economy as essential components in sustaining Europe's enviable standard of living. Thank you for tuning in.